down. Hopefully, we jumpstart your trading day and occasionally put a smile on your face. And speaking of Mr. Michael Brown, he's already in the room, so let's invite him to be a co-host. That is winging its way over to him right now. Whilst he is logging in, let's get the legals ready.
Good morning, Ryan. Good morning, everyone.
Morning, my good friend. Morning. Let me just get the legals out of the way. As usual, nothing discussed on this spaces session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, James PIQ or PIQ Suite, or indeed the affiliates, which, as you know by now, is Mr. Michael Brown, yay, and myself, Ryan. Yay. Yeah.
Deary me. You seem very overexcitable this morning, Ryan.
I think it's just the lack of sleep all week has now just turned me mildly insane.
Oh, dear. Well, you weren't far off that point anyway, so
Yeah,
it wasn't a long journey, was
I
it?
was I was potentially mild already, so majorly maybe. Anyway, enough about me.
You said it. Indeed. Right. Moving on. Good morning, everybody. Of course, all eyes yesterday on the CPI figures that we had out of the United States, and principally the core inflation numbers, which, of course, for those who are unaware, is CPI excluding the more volatile food and energy components. In
Who
terms
needs
of
food and energy? Who needs food and
well,
energy?
exactly, and it's that age old thing of if you take out the prices that are rising, then you have no inflation whatsoever. You can look at a core metric if you really want to, but we won't do that this morning. Instead, we'll run through the numbers. Headline CPI rose by 0.4% on a monthly basis in December, bang in line with market expectations, while also rising by 2.9% on an annual basis, again in line with expectations and the fastest annual rate of inflation in the United States since July of last year. It was, though, the core metrics that really stole most of the market's attention, with core CPI rising by 0.2% on a monthly basis, cooler than the 0.3% that participants had expected, while core CPI also rose by 3.2% on an annual basis, again a touch below the 3.3% expectation and the slowest core increase since August of 2024. Naturally, that was enough to set the hairs running in terms of risk, with the S&P 500 closing about 2% higher and the Nasdaq 100 leading the charge, ending the day about 2.5% higher. And that came amid a dovish repricing of Fed policy expectations. Looking at market pricing this morning, we now see the first 25 basis point cut being priced for the July meeting. Of course, that compares to the October meeting where we were after the payroll figures on Friday. And we also see around about 39 basis points worth of cuts priced by the end of the year. And that's about 10 basis points more than we saw after the jobs numbers on Friday. So a big dovish repricing of policy expectations. We've also seen treasuries rally as a result of that, really just a dovish move across the board, to be honest with you. Treasuries gaining by 10 basis points in the 2-year, by about 15 15 basis points in the 10-year yesterday, and the dollar subsequently softening on the back of that. Although it was interesting to note, actually, that the dollar roared back late in the day, with the dollar index closing the day north of the 109 handle and remaining north of that figure this morning. That in turn saw cable back away from a test of the 123 handle, and also saw the euro come back from a test of 103.50 to the upside to trade south of 103 this morning. Besides the CPI figures that we had out of the United States yesterday, there was plenty else for participants to digest on the geopolitical front. Without wishing to veer too much into Ryan's territory, we did have news yesterday that Israel and Hamas have agreed a ceasefire deal. For those who were expecting this to last, don't get your hopes up, because as I speak, Bloomberg is reporting that the Israeli PM's office says that Hamas is reneging on the agreed upon points within that ceasefire. So by my estimation, that lasted for a grand total of about 13 hours, and the geopolitical situation in the Middle East rumbles on. In terms of the monetary policy side of things, we had some sources reports also via Bloomberg overnight relating to the Bank of Japan. The BOJ is said to see a good chance of a January rate hike, but that hinges on there being no negative surprises or market shocks in the early days of President-elect Trump's administration. Of course, Trump is inaugurated on Monday. The BOJ meet next Friday during the Asia session, so of course they will be watching very, very closely to see what Trump does in the early days of his administration. These sources also reporting that the BOJ will be checking data up to the last moment before deciding policy. Again, you kind of hope that they were going to be doing that anyway, to be completely honest with you.
Yeah.
But nonetheless, these sources reports did cause a little bit of yen strength overnight. Dollar yen trading down to about 155.25 at the lows, although we have probably paired about half of that move as the session has progressed. In terms of other monetary policy matters, we did hear from some Fed speakers yesterday, Barkin, Williams and Goolsbee, all very much kind of sticking to the scripts that inflation is on its way back towards 2%, that the trend in inflation is an improving one, and that they will continue to remove policy restriction as the year progresses. We also heard from the BOE's Alan Taylor yesterday. This was his first speech since he became an external member of the Monetary Policy Committee towards the back end of last year, really staking his claim to be one of the more dovish members on that committee. Obviously, he dissented in favour of a 25 basis point cut at the December policy meeting. He was saying that it makes sense to cut rates preemptively, that the economy is weakening, but he believes the UK will achieve a soft landing, and that he thinks now is the time to get rates back towards normal. Before anyone in the comments says it, a lot of people would say that actually bank rate being at 4.75% is normal.
I
If you
nearly
take
said
a
it
chart
myself.
of that and zoom out a long way, if this chap thinks that 0% ish rates is normal, then we may have a bit of a problem on our hands. Other bits and bobs. Yesterday, we had a 10-year gilt auction in the UK, which did have a big bid to cover of 2.8, but that was the least oversubscribed since 2023. So clearly, still some lingering concern about the fiscal backdrop here in the UK. We also had the start of earnings season yesterday. I won't run through all of the numbers from the banks because we'll be here all day. But the sort of top line takeaway was that bank earnings were pretty strong. JP Morgan actually delivering the biggest annual profit that any US bank has delivered in history. And as a result of that, we saw some generally broad-based strength in financials and in the banking sector yesterday. Yesterday, we heard from Wells Fargo, JP Morgan, Goldman Sachs and Citi. Today, before the open, we hear from Bank of America and Morgan Stanley. And last but by no means least, just a couple of data points that we've had out overnight and early this morning before I hand back to you, Ryan. We had some labour market figures out of Australia overnight. Unemployment ticking higher to 4% from a prior 3.9%, bang in line with market expectations. We also had employment, which rose by about 56,000 in the month of December. But if you dig into the details of that report, full-time employment fell by 25,000 and part-time employment rose by 80,000. So by no means is that as good as the headline figure would imply. We have seen the Aussie face a few headwinds as a result, and the market pricing about a 70% chance that the RBA deliver a 25 basis point rate cut at their next meeting on the 18th of February, although that is, of course, still a very, very long way away. And last for now, we also had GDP figures out of the UK this morning. The economy returning to growth in November after 2 consecutive months of contraction, although that growth was just to the tune of 0.1% on a month-on-month basis. So it is really not worth celebrating or shouting about. On a rolling 3-month basis, which obviously covers the period from September to November inclusive, the economy stagnated. That was compared to growth of 0.1% in the prior 3-month period. The nub of all of this is that, broadly speaking, the economy continues to stagnate. Rachel Reeves has been waffling this morning about wanting to go further and faster in terms of economic growth. Forget going further. Let's just get some growth would be nice. And the Chancellor's big idea today to get growth, she's calling all the regulators into the Treasury to have a meeting about how they can promote growth, which I think tells you everything you need to know.
I did see someone on Twitter today say she couldn't, rather than delivering growth, she couldn't deliver a pizza.
Well, yeah, I think that's probably about right, to be honest. It's, utterly ridiculous, to be completely frank.
Yeah, it's pretty shit, let's be honest.
I think, that Well, yeah. Just lastly, I think the big takeaway from that is, yes, the data we've had from the UK this week. Yes, inflation was a little bit cooler than expected yesterday. GDP has missed expectations this morning. Broadly speaking, the narrative has not changed now compared to where we were before this data came out on Tuesday afternoon.
Yeah,
We're still looking at stubborn price pressures, and we're still looking at stagnation in terms of growth. So, yeah,
yeah.
certainly very, very little reason to for optimism.
I agree. I think, and I believe that's being polite. Well, thank you for that.
Yes, I
So let me
was.
crack on with some of our headlines via Zach, who is currently in a very damp Thailand. I
Oh, is
mean,
it raining out there?
weather-wise,
What a oh,
yeah,
what a
it is.
shame.
It is.
Oh,
That was the first thing I said to him
oh.
this morning. I
Where's
was a
that
little bit.
little?
I was pretty happy this morning when I saw his Instagram and it was pissing down with rain. I was like, yeah, poke it. But before I do, some unfortunate news on the more PIQ personal front. One, for some reason, Twitter, in its wisdom, has decided to automatically shut down our new breaking news Twitter handle for being inauthentic. So I don't know what that's about. So
Oh,
I've appealed it, and hopefully that's just the computer saying no for some unknown reason. And also, more importantly, perhaps, Mr. Tom Wiseman, who's listening in this morning, blow me out for a beer later on. So what a mug, what a cunt of geezer. Yeah, poke it. So if everyone can like fire some abuse at Mr. Wiseman, that'd be greatly appreciated. But anyway, enough of that. Enough of my social life. Back to some overnight headlines via Zach. Starting off in macro space as we usually do. US President Biden warned, I know he said Trump then, warned in his farewell address that an American oligarchy is taking shape among a few tech billionaires who have amassed a dangerous concentration of power. I wonder who he's referring to there. Outgoing Treasury Secretary Janet Yellen said that Trump's plans to set up a new government agency to collect tariffs would duplicate an existing agency and would unlikely to save money. Well, let's see what he can do that's different to what you did, Ms. Yellen, sorry. People's Bank of China might cut the triple R rate before the Lunar New Year this month, which is 29th of January. That's according to analysts cited by the Shanghai Securities News Organization. Chinese officials and automakers are eyeing German factories slated for closure and are particularly interested in Volkswagen sites in efforts to build influence in Germany's prize auto industry. I would love to see how this is taken by the German people. I think this could be a proper fox amongst the chickens. Pension funds are increasingly dipping their toes into buying Bitcoin in a sign that even typically staid corners of finance are finding it hard to ignore the potential outsized returns from cryptocurrencies. I'm sure our good friend Cam, who's listening in, will be including something along this, or at least that headline, in the crypto blast that he'll be putting out momentarily. In geopolitical news, the Biden administration is exploring ways to keep TikTok accessible in the US, even as a ban is set to take effect on Sunday. So why ban it? Trump is also considering an executive order once in office that would suspend enforcement of a TikTok ban or sale law for 60 to 90 days, buying the administration time to negotiate a sale or alternative solutions. So again, why ban TikTok in the first place? It seems a complete mess.
I agree with you on that. Specifically, when you consider that, and I haven't read too much into the subject, but you would imagine that one of the reasons why they're going forwards with this ban is because, let's be honest, TikTok is owned by the Chinese, and the US and China don't exactly get on. And are they worried about what China are going to be doing through TikTok on people's phones? You'd think if that was the sort of reasoning and the rationale behind the decision, you'd want to get that shit off of people's phones ASAP, wouldn't you?
Well, if that was the real reason, yet Biden and Trump are considering ways to kind of delay the ban if they do decide to put the ban in anyway, is
Very
bonkers.
odd.
Although you did remind me of, and it's completely off on a tangent, if anyone's seen Brass Eye back in the day, where about what the Chinese can do to you through your phones, reminded me of the old pedos coming through your keyboard. But anyway, moving on.
Oh, bloody hell.
Where was I? Oh, I was making some errors. Is Rich our HR on at the moment? No, he's not. Okay, right. No one tell him.
Thank God for that.
Finally, in geopolitical headlines, UK PM Starmer will sign a 100-year partnership treaty between Britain and Ukraine in a show of support for Zelensky ahead of Donald Trump's inauguration as US president next week. Oh, quickly, back to TikTok. The TikTok CEO is planning to attend Trump's inauguration. There's a little one for you. In equity space, TSMC logged record quarterly profit on Thursday and said it expects hefty first quarter revenue growth as demand surges for chips used in AI processing. Apple's smartphone shipments in China plunged 25% in Q4. That's according to data from Canalys. It looks like Huawei took the market share away from them. That's according to an article on Reuters. Tesla started offering discounts on new Cybertruck vehicles that remain in its inventory this week. That's according to listings on the company's website. Jeff Bezos, his space company, launched its massive new rocket. Oh, Ryan, grow up. For the first time, aiming to advance Amazon founders' lifelong space exploration ambitions. I love a massive rocket. Sorry, I couldn't help myself. Goldman Sachs CEO Solomon said there is an end in sight to the multi-year IPO drought. So potentially a good year ahead for IPOs. Enough of me and my smutty mind. Back to you in the studio.
Thank God for that. Right, moving on from whatever the hell Ryan was on about just there and to the session ahead.
I honestly don't know.
Nor do I. There are a few bits and bobs worth noting today, actually, in terms of scheduled events. Kicking things off at 12:30, so lunchtime, is the release of minutes from the December ECB meeting. Of course, the ECB delivering a 25 basis point cut at that meeting, and the market also fully pricing another 25 basis point cut for the January and for the March 2025 meetings as well. I think key focus within those minutes will be any discussion around the neutral rate. Of course, Lagarde at the press conference saying that we are getting rates back to neutral, but at the same time saying they don't actually know where neutral is. So I think it would be interesting to see if the ECB were discussing where that neutral figure lies, and also whether they need to take rates below neutral and into outright loose territory at some point this year in order to stimulate the Eurozone economy and also to insulate the Eurozone against some of the numerous downside risks that it continues to face. Away from that, it is a busy US session this afternoon. We've got a bit of a data deluge out of the States at 1:30 this afternoon. We have the December retail sales figures due. Headline sales seen rising by 0.6% over the festive period. That's compared to the 0.7% rise that we saw in November. The all-important control group metric, which broadly represents the basket of goods that feeds into the GDP release, that is seen rising by 0.4% on the month, and that would be unchanged from the pace seen in November. Also out of the States today, we have the weekly jobless claims figures, although neither the initial nor the continuing claims print will pertain to the January non-farm payroll survey week. We also have manufacturing figures from the Philly Fed. Their index expected to rise to -5 from a prior -16.4. And we also get import and export prices today as well. And of course, they are, for those who are unfamiliar, a key input into the modelling around the PCE inflation print, which is of course due at the back end of the month and is also the Fed's preferred inflation metric. In terms of other things to keep an eye on today, the central bank speaking calendar is relatively light. Just the ECB's Panetta and the BOC's Gravel due to make remarks today. I was also reminded yesterday, actually, that the Fed's pre-meeting blackout period starts at close of play on Friday, which I think will be welcome news to market participants across the world. And as I alluded to earlier on, we do have a relatively busy slate of corporate earnings once again today. Not only the banks, Bank of America and Morgan Stanley reporting before the market open, but also for those who trade the Dow, we hear from earnings from United Health today. And of course, they are the second biggest stock by weight in the Dow as well. So worth just bearing in mind if anyone has any exposure there.
Remind me again, what's your opinion of the Dow?
Oh, it's just old and antiquated and out of date. It should be, put off.
Enough about Richard Matthews.
If it was a dog, you'd put it out of its misery.
Wow.
The Dow, not Dickie. Let me say that. Let me clarify.
I was going to say, well, I hope he's not listening.
I'm seeing him on Monday, so.
Oh God. Well, speaking of seeing, beer later. I think some of the Royal Tunbridge Wells crowd are around, so I'll give you a shout. But
Cool.
anyway, we can do our social life kind of arrangements after the show. But anyway, listeners, Michael, thank you so much for coming on. Listeners, thank you so much for listening. Keep an eye out for Cam doing his crypto blast very soon. That'll be coming out on his accounts. Follow him. He's obviously listening in at the top here. I'll be reposting it. We are going to be getting these on Spotify when I find an extra few hours in the day, because at the moment I am busy. Yeah, I'm tuning in tomorrow, and no doubt we'll give you some more insight to kickstart you off. Thank you for that, and goodbye.
See you later.
See ya.